Welcome to today's webinar to do with navigating the Trump tariff storm, what Australian investors need to know. I'm Ashley Murphy, the founder and principal of Arete Wealth Strategists Australia. Please note these disclosures. Today's presentation does not constitute personal financial, tax, or investment advice. These are observations about broad macroeconomic trends and what you might do to better position yourself in light of these factors. I should note we have a YouTube channel. If you register for a presentation and you cannot make it, you'll be notified typically within 24 hours of when that presentation is posted, and you're able to see that. I would encourage you to subscribe to our YouTube channel. We have many dozens of presentations to do with all manner of topics that affect Australians in America, Americans in Australia, and those like myself planning and living their life between the two countries. Just a brief background as to who I am and how I came to be running this particular wealth management firm. I was really born into it as a tri-citizen, born in the UK, raised in Australia, spent 20 years living in the US, and now live between Australia and the US, 9 months in Australia, Brisbane, in case anyone's wondering, and Minneapolis, Minnesota. Just got back from the US last week, as a matter of fact. So I went to the University of Queensland, moved to the US in 2005, worked as a corporate financial analyst for a little while before I saw the light and started my financial planning studies. So I've really been in this business for about the past 15 years, running Areté Wealth Strategists Australia, as well as the Global Financial Planning Institute. The kind of clients that Arete Wealth Strategists work with are Australian business owners, high net worth families living between the two countries, or executives who permanently relocated to the US. And I have news to share, and that is I am presently, actually as of this afternoon, I'll be having a more advanced conversation with an Australian financial services license holder that will be looking to add me as an authorized representative under their AFSL, which will make Arete Wealth Strategists the only duly qualified and registered wealth manager operating between Australia and the US. So that's a very exciting development right there. Okay, so an outline of today's presentation. We're going to go through 5 topics. First, looking at an overview of Trump's tariff measures and the timeline of recent events. And boy, has there been a lot of developments. That timeline really has daily and even intra-daily developments. Next, a broad set of slides to do with market volatility, economic implications, and sector-specific impacts. Next, we'll be moving on to investment strategies for times of uncertainty, such as what we're in presently. Looking then at the currency between the Australian dollar and the US dollar, forecast and drivers there. I think that's worthy of its own topic because so much of the return that an investor enjoys, especially an Australian investor, where 2% Australia is representative of 2% of the world's listed companies. It has an GDP has a very small part to play, and so Australian portfolios are very internationally diversified, and when denominated back into US dollars, that currency volatility can have a huge impact on end returns. Lastly, we'll be looking at a conclusion and actionable insights from what we've observed here today. Okay, so let's get into it. An overview of Trump's tariff measures and the timeline of recent events. So when we boil it down, with all the things that have been announced and then repealed, where are we right now? We're looking at a proposal for a 10% baseline tariff on Australian exports. That was a particular shock and insult, I would say, given that Australia, not only is it one of the US's closest defense allies, but we run a trade surplus with the US. The US is exporting more stuff to us than we are to them, and they still hit us with a tariff. So that really doesn't seem very sensible to me. There was 125% tariff placed on Chinese goods. That's been elevated. We're up to, I believe it's a total of 147% now on Chinese goods. And a temporary 90-day pause is now in effect for countries to come forward and make their proposals. I think there'll also be time to hear from big business in the US and We'll see what happens. There was an editorial written in the Financial Times talking about this, and they were really saying how it's comforting and it's natural to try and thread a needle through all of the different pronouncements that have been made. But I'm here to say I don't think there is an overarching grand strategy. I think if you see the way that the simplistic formula that's been used to hit countries with tariffs has been applied, and how that is affecting an overarching military strategy to contain China, doesn't seem very effective, especially if this containment strategy is to work. It's got to include countries like Vietnam, for instance, where there's been a lot of nearshoring of production from Chinese companies. But if the US is alienating Vietnam, which they are, and Xi Jinping was just in Vietnam announcing or on a charm offensive to try and win them back over, then it really doesn't seem like there's coordinated economic and military strategy going on. So I'm just going to call it as I see it. Okay, so why tariffs? What's this all about? So the administration has justified the need for these tariffs based on rebalancing trade flows, and I think there is some case to be made for a number of these points. I think it's probably long past due. I think it was in the 1990s when the horse bolted from the barn, and now it's time to put it back in. But perhaps the way that that's being done has not been managed quite so effectively. So rebalancing trade flows, addressing non-reciprocal practices when US markets are more open than partners. That doesn't always happen just with tariffs. There can be other non-tariff measures, stealthy subsidies given to domestic manufacturers, etc. There's a revival of US manufacturing. The trouble with that point, I mean, I certainly get the reshoring of US manufacturing, but it would seem that research suggests that the decline in the numbers of folks involved in manufacturing, the largest factor is not offshoring, it's technological advancement. It's the increased automation in manufacturing processes. One need only look at a cutting-edge production line in China, actually, or Japan is probably a better example, to see that, or Tesla in Fremont, to see the number of people that are now involved in modern manufacturing. It's just a fraction of what it used to be. And that's only going to accelerate when we think about how AI is being applied in the manufacturing realm. Another laudable argument here would be securing supply chains. I think we've seen that in recent years during the pandemic, looking for personally protective PPE, personal protective equipment. Turns out it's all the gloves are manufactured in Malaysia, which wasn't a problem until it was. Same thing with masks as well. They're all manufactured in China. And when China's 1.3 billion people had to deal with the pandemic, guess who got priority access to those masks? And protecting national security. That's an interesting point, actually. 3 and 4 come together in the form of these rare earths, which are not rare apparently, but that's what they're called. So all sorts of specific minerals required for advanced manufactures that particularly impact high value-added manufacturers, complex manufacturers in electronics and also in defense equipment as well. So this happens to be one of the areas where Australia will do well out of this disagreement that the US and China are having, because Australia happens to be home to a number of those rare earths, and same coincidentally with Ukraine as well, although that's a more complicated and very different picture. So implications of these tariff measures, broadly speaking, include currency volatility, and boy, have we seen some wild volatility in recent times. Shifting trade alliances, this is probably the biggest long-term impact, is the shifting trade alliances. Countries like China trying to diversify partnerships and marginalize US influence. That's also happening with US Treasury holdings, probably more detail than what what most people are interested in getting into here today, but the proportion of US treasuries held by China has actually been declining for the past 15 years. And while there is sense, but the bond markets are the canary in the coal mine in terms of communicating the financial appetite for the proposals. We've seen some sensitivity to recent Treasury issues. It is worth noting that China holds a tiny percentage, or a very small percentage overall, of the tens of trillions of US dollars in that are held in treasuries. So let's not overstate their holdings there. Domestic inflation, I think that's going to be especially bad. Domestic, I've got to be clear when using the term domestic, what country are we referring to? We're referring to the US. I mean, remember, Australia is not talking about introducing massive tariffs all of a sudden. This is a US phenomenon. And of course, dealing with the largest and second largest economy in the world, there's going to be ripple effects. But there are, in fact, talks of areas of the Australian economy that could see decreases. So deflation, given the spillover and surplus of Chinese goods that might have otherwise gone to the US, might come back to Australia in the form of some cheaper imports. So let's put some silver lining on the cloud. However, for US consumers, it'll be none so pretty, given the tariffs that we're talking about here. Okay, timeline of recent tariff announcements. So I think we could go back to slightly earlier than this, go back to really the president's inauguration, January 20th. There was talks of tariffs in his campaign. So this didn't come as a huge surprise. We hit an all-time high in the S&P 500 on February 19th, but it really only was in March that the momentum began to build around tariffs and what this announcement would be in this so-called Liberation Day that came in early April. So on March 5th and 6th, Trump grants a 1-month exemption on new tariffs for goods from Mexico and Canada. That was a welcome reprieve. I think the talk in February had really been a surprise to everyone, suddenly due to apparently illegal immigration coming from Canada, which is news to me, and fentanyl supplies also coming from Canada, which is also news to me. They got hit with all sorts of threats of tariffs, but there was a 1-month exemption imposed there. The US, just on a related note, I should say that inbound tourism has taken an enormous hit. It's only in recent years that we also saw enormous hits from COVID, but I don't think COVID is a relevant comparison for this purposes. We're in, relatively speaking, normal biohealth times, right? So why should there suddenly be a 25% decline on the most profitable tourist routes between Europe and the US? And it's not Americans going to Europe, it's the other way around. People have been spooked by detentions at the border. Okay, next day, Trump extends the delay to many imports from Mexico and some from Canada, but signals reciprocal tariffs from April 2nd. In late March, Trump announced a 25% tariff on worldwide imports of automobiles and parts, including engines and key components. And it was around this time that BYD, Build Your Dreams, a Chinese electric car manufacturer, also announced that they had made headway with regards to a fully autonomous driving mode, which was offered for free in their vehicles versus Tesla, which I believe it's $5,000 to get their quote unquote fully autonomous driving mode. So the commentary seems to be that China's pulling away in terms of the next generation of vehicle manufacturing. So that is not good. April 2nd, Trump declares a national emergency of the US trade deficit, invokes the International Emergency Economic Powers Act, many decades old, and it is a creative use of executive powers to be able to do that. Announces a universal 10% minimum base tariff effective April 5th, and announces this was the so-called Liberation Day. I noticed they didn't put it on April 1st. That might have been more fitting. Announces higher reciprocal tariffs for countries with the largest US trade deficits, including China, to take effect from April 9th. Okay, so April 3rd, 25% tariff on automobiles and parts takes effect. Remember, folks that may not have traveled to the US recently may not be aware, you can't buy a Chinese vehicle in the US. If one travels to Europe, or certainly here in Australia, all over the road, in fact, sponsoring major events, you see these Chinese car companies. So for the US to simultaneously slash green subsidies, to raise tariffs on international exports, I think they're at risk of turning the US automobile sector into the Galapagos Islands, where they deprioritize electric vehicles and continue pushing ICE, or internal combustion engines, in a time when the world is moving towards electric. It was actually just earlier this morning I watched a video that showed if anyone happens to watch that British TV show Top Gear, the fastest ever lap around their test track has now been done by an electric vehicle, replacing a hybrid Formula One car from many years ago. So it would seem, I mean, that's, yet again, I'm saying canary in the coal mine, but it would seem like that's the direction of where the automotive sector is headed. April 4th, China retaliates 34% tariff on US goods. She is standing firm and mostly, perhaps not entirely, but mostly matching tariff for tariff. It's gotten to a point where it's somewhat ridiculous. I mean, above 100%, who really cares if another 30% is added on to what are already close to 150% tariffs? April 5th, the 10% universal tariff on all US imports takes effect. So it's in effect now. Trump raises the reciprocal. So I bought my shoes in the US in late March. So I just got in under the line apparently. April 8th, Trump raises the reciprocal tariff rate on China to 84% and increases de minimis duties on small parcels from Hong Kong. So there's what is it, the Alibaba and the other very low-cost Chinese producers getting hit right there. April 9th, Trump further increases US duties on Chinese imports to 125% on top of the 20% existing already. Reciprocal tariffs reciprocal tariffs above 10% for other countries are paused for 90 days, except for China. Exemptions announced for goods already in transit. Okay, gosh, hard to keep track of everything going on by this point. Stock markets rebound sharply, massive decline, but massive recovery. China raises its tariffs on US goods to 84%. Well, the problem for the US, as shown in an article again in the FT earlier today, which was an excellent article, was that China is in a stronger position for this particular negotiation, because not only is it importing less from the US, but what it's importing is lower value agricultural products by and large. Yes, Boeing jets and certain car parts are exported, but the majority, the bulk dollar amount of assets going to China are things like beef and soy and soybeans and basic commodities that could be rerouted to Brazil or Australia. April 11th, the Trump administration exempts electronics such as smartphones and computers, okay, but may face further future tariffs. China raises its tariffs to 125%. And so here we are in this ridiculous bidding war of tariffs. April 14th to 15th, discussions continue about further tariffs on here we are. Now we're getting serious. Semiconductors, pharmaceuticals, and critical minerals. This is where it's at. The high value manufacturers and the things that have defense and high manufacturer value added abilities, which is where the critical rare earth minerals come in. US trade weighted average tariff reaches an estimated 24%, the highest in over a century. Now that's from everywhere. That's not just China. That's the average from everywhere. So this is what's going on right now. Market volatility and economic implications. Let me show you what I've got. Okay, so US market impact. So as I mentioned, February 19th was when the S&P hit its last all-time high of 6140. By April 2nd, after that whole time, most of the events in that timeline had taken place, the S&P had declined by 8%, not so bad to that point. And then the following week declined to 49.88, which was a really significant decline. So 19% from peak to trough. And currently it's rebounded quite a bit, but still 12% down from the all-time high, 8% down from the beginning of the year. So no one is enjoying that. The VIX volatility index, that surge, typically long-term average is about 16. So volatility is way up there at 37.4, a level not seen since the pandemic. And I think we're likely to stay there for a while. So the VIX shorting trade is probably not a good one at the current time. Now, let's keep in mind Australia, the Australian economy is not the US economy. So what's happened on the ASX 200? Very different story, nowhere near as volatile. The benchmark index initially plunged 8% on April 3rd. That fourth there is a reference, sorry. Reflect not the 34th day of April, that's April 3rd, reflecting investor panic over global trade disruption. The partial tariff pause triggered a relief rally, the single largest day rally since March of 2020, right during that COVID correction time. But volatility persists, driven by the uncertainty over the tariff situation and retaliatory measures. So what are we seeing? We're seeing a growth slowdown, but nowhere near as much in Australia as the US. Why? Because, as I said before, it's not Australia that's talking about imposing tariffs. That's the US that's doing that. So inflation may rise a little bit, but not very much. Again, nothing like what it would be in the US. And indirect risks loom from slowing US and Chinese economies. Now, that's a problem because who does Australia primarily export? That is China. And together, these two countries account for 27% of Australia's exports. But thankfully, Australia's fairly well diversified with regards to its exports, as you see there, with the other 73% being accounted for with other countries. The monetary policy shifts. The Reserve Bank of Australia is expected to cut rates, assuming the base case persists. We're expecting a rate cut all the way down to 2.6%. That could have inflationary pressures, stimulate borrowing, and really see the housing market possibly increase again. However, we do have an election coming up, and the affordability of housing is already a problem. So it would be a long call today to talk about what might happen to the price of housing on a nationwide basis, given that valuations are already so stretched here. And that's really that second bullet point that you see just a moment ago. Global and long-term implications. The uncertainty and confusion surrounding tariff implementation with frequent changes, exemptions, and pauses have amplified volatility, as we saw with the VIX a moment ago. And this is where I just can't help but pull my punch and just call it for what it is. This is no way to run a country or a global economy. Businesses make investment decisions based on many, many years, not the current administration. And so for a manufacturer to talk about resourcing to the US, resourcing manufacturing, that still might not make sense if the next administration were to undo some of what we see here. If I were to guess, I would say that even if a Democratic administration came in, they probably wouldn't repeal these tariffs entirely. They may reduce them, but the broader implications, the broader reasons for the tariffs, I think, are justifiable. And we did, in fact, see a lot of continuity, interestingly, between the first Trump administration and the Biden administration. So I don't expect these things to be repealed entirely should a new executive come in at the next election. Okay, the tariff rate in the US is now the highest it's been in nearly 100 years, fundamentally altering global trade dynamics. If they persist, for sure it's going to result in big inflation in the US. It's going to be it's essentially a regressive tax. And so the one argument that's been aired, particularly from Peter Navarro, one of the would seem leading economic strategists in Trump's ear, is that prior to the 1940s or late 30s, when an income tax came in large part to fund World War II, the majority of tax receipts was coming from tariffs. But the experience of the 1930s, I don't think many mainstream economists look back at that time and approvingly and say that that was a great way to run the global economy, by everyone erecting their own tariffs and really halting global trade, putting it into reverse from where it had been in the 1920s. So retaliatory tariffs from China, the EU, and others have further reduced US export prospects and contributed to global economic slowdown. That's probably no more demonstrated than in the defense sector. Again, may have been necessary, but the way to do it by pulling the rug on the EU, and I think, according to EU politicians, they say the transatlantic alliance is over. It's actually provided the greatest stimulus to Rheinmetall, Thales, and other European defense manufacturers, because they've decided they can't rely on the US. And so while sales at US companies are up, there's nowhere near like what has happened with EU defense companies. Yet again, I think there was a missed opportunity in how that was communicated. Sector-specific impacts. So banking stocks have shown resilience, buoyed by strong earnings, while sectors targeted by tariffs, namely aviation, semiconductors, and consumer electronics, have seen pronounced volatility. Now, aviation is interesting because obviously Australia's not exporting a lot in that realm. It's more US exports to China there. Semiconductors and consumer electronics would be the other direction, coming from China to the US. Again, it's volatility. It really doesn't matter which direction it's happening. It's affecting volatility. Gold, interestingly, it was pegged. It was, excuse me, not pegged. Scratch that from the record. It had technical resistance around the $2,000 mark for years, and it seems just in the past couple of years, it has caught up for decades of underperformance, and it's now at an all-time high. Agriculture, I mentioned this a little bit earlier. This is where it could actually play to Australia's benefits, because with the US primarily exporting agricultural products to China, Australia is well placed to be able to replace that particular export opportunity. Consumer goods, cheaper Chinese imports possibly for Australia, and boost retained earnings in Australia. It looks like there's a chat here. Will Lyons has written, actually, Boeing Aerostructures Australia is actually Australia's largest manufacturing exporter by value. Well, I would have to look at that, Will. I am dubious. You're telling me that Rio Tinto is outperformed by Boeing in Australia? I don't know about that. But nevertheless, I would have to look into. Oh, in manufacturing. Okay, Australia's not exactly known as a large manufacturing exporter, but your point is, I don't have any basis to disagree with the point that it's the largest exporting manufacturer. Okay, investment strategies for uncertainty, maintaining this is counsel for all periods of uncertainty, and I think it really applies now as well, and that is avoid panic selling. Thankfully, every downturn, every shock is different, and in this regard, because this has been so clearly identified as coming from really one man and one administration, people have not had the same response that they have had. I have not seen much in the way of panic selling from or any. I've seen stress, I've seen anxiety from clients, but I have not seen or heard of panic selling. And certainly that is something that I think recent volatility would show would have been a foolhardy decision, given the recoveries, the rapid changes that we're seeing in markets and currencies lately. Rebalancing portfolios to adjust allocations to align with target risk levels. This is particularly important. Selling overvalued assets and buying undervalued ones. So retreating to more of a value over growth perspective, looking back to the fundamentals of companies, being less based on momentum and sentiment. Diversifying across assets and regions, geographic. So we're still pretty US heavy because we think that the growth sectors in the US, namely in IT, are defensible, are ones that will have a sustained story to them. But I think there's also times like these also call attention to the value of exposure in other geographies. The countries with the greatest returns year to date, or developed markets year to date, has actually been Europe, which has been a laggard for the past couple of decades. Fixed income focus, prioritizing short-term bonds and emerging market US debt for yield without excessive duration risk, and emergency reserves. Now is the perfect time to look at that emergency reserve, consider your own situation, and see whether or not you have anywhere from 4 to 6 months to withstand a major downturn, 4 to 6 months of non-discretionary spending. With regards to deploying excess cash, we would suggest a dollar cost averaging approach is what makes sense in a time like this with this volatility. Nier Duncan writes, thank you. Sorry to have to draw. Okay, yep. Well, that's very kind of you to write and say that. Next, fixed income and currency considerations. Consider hedging, or if not hedging, not outright hedging, then perhaps mitigating, keeping a watchful eye on that exchange rate. And that's the next topic coming up in just a moment. It is possible to obtain, this is something we can do for our clients. We're able to obtain what's called a currency forward. So that's a pre-agreed agreement to exchange at a particular rate at a particular point in time. We'll get to that in just a minute. But monitoring points would be, keep an eye out for the RBA and Fed policy cuts. There might be rate cuts coming from the RBA. We'll see about that. It's very tricky to call in a time like now. I'm not seeing it. I think the RBA is focused on maintaining and bringing inflation down, while there will be a mild inflationary impact to Australia from this overall, as you saw earlier, the 0.1%. I think they're primarily concerned with bringing inflation down in Australia rather than stimulating. Stimulating would be necessary if there was a major slowdown. So I personally, I think that there may be, we'll see how things play out, but there may be more moderate rate cuts than what what you might read elsewhere. Okay, Chinese stimulus. Let's keep our eyes peeled for what the Chinese government does. Apparently, the commentators say that China has an enormous opportunity to grow their own domestic market share by encouraging domestic consumption. As we've all heard that statistic, that 2/3 of the US economy is driven by consumers. It's a fraction of that in China. There's still enormous savings versus US individuals there. There's concern about providing for retirement, and then just general mistrust of the economy in general. So if the Chinese Politburo can do what they can to encourage domestic consumption, then China might be able to really insulate themselves from the worst of the tariff wars here. So forecast and drivers of the US and Australian dollar exchange rate. So I thought it would be best to just start with where we are and where we've been. So currently, this was taken only about 45 minutes ago. We've rebounded completely, and some actually, from where we were at the beginning of April. It was right around April 8th that we hit this low of mid 59 cents. That's about as low as it hit during major economic crises, looking at the COVID correction. having to go back to the GFC before that, and then all the way back to around the time of September 11th. So we are talking recent historical lows let me rephrase that. The low we hit at the beginning of last week was near historical lows. We're now back around 63 cents, which has been more than a full recovery. But look at the trend line. We're going back here to 2021, and you can see it's clearly showing a depreciation of the Australian dollar over that period of time. Okay, so what do we see out there? Key drivers of the exchange rate between Australia and the US. It's driven by interest rate differentials between the two countries. Markets priced in 120 basis points. That's 1.2% of easing in 2025. That would be on the RBA side. Like I was saying a minute ago, I would be surprised if it was as much as that, but this is what the market's saying. Driven by moderating inflation and growth concerns, the Fed, perhaps they pause, they take a cautious stance that widens the rate gap, pressuring the Australian dollar, as in people don't want to hold Australian dollars, they'd rather, this is the so-called carry trade, people want to hold a currency where they're earning a higher rate of interest. That's the thesis behind the interest rate differentials. Trump's tariff policies. So US strength, reciprocal tariffs and fiscal expansion boost the US dollar, while indirect risks to Chinese demand weigh on Australian-linked, AUD-linked commodities. Temporary tech product. I think that the tariff policies, I really should have just put a big question mark after that. We really need to see what happens there. Commodity prices, they're going to be driven by broader macroeconomic conditions. Again, if there's a Chinese stimulus, then that actually could end up playing well for Australia, to do with iron ore and liquid natural gas. And green energy demand, 21 billion in Australian hydrogen projects may offset losses if US-China trade fractures deepen. Okay, so near-term forecasts, fairly wide range here, but this is what happens in times of high volatility. We don't see an immediate lower case for a lower exchange rate below 59 and possibly bouncing up as high as 65 cents while we await tariff headlines and announcements from the reserve banks. Year-end outlook, NAB is going on the higher end. They're going to 65 to 67 if tariff tension stabilizes and China avoids a hard landing. Downside risks, which it's all in how you look at it, right? Is that really a downside if the exchange rate for someone moving US dollars to Australia, this is more of an upside. But sub 60 cents are possible with Chinese yuan devaluation or a US recession. And we certainly can't rule out the possibility of either one of those events. Looking further ahead to 26, 27, we're seeing a gradual recovery to that 68 to 70 cents if tariffs ease and China avoids a hard landing, or the downside, worst case scenario for China and the US at least would be a prolonged trade war and yuan devaluation that could trap the Australian dollar in that high 50-cent range. Jim Lidster asks, how certain are the hydrogen projects to go to full production? I really I cannot answer that, Jim. Unfortunately, that's too granular for me. I subscribe to the Financial Review, but I have not been paying close attention to those projects. I apologize. Key drivers, again, interest rate differentials, commodity prices, and we'll be watching to see what the RBA says in May. So, conclusion and actionable insights from what we have here today. Expect ongoing volatility, but not necessarily crisis. One thing we know about President Trump is that he does not like to see major declines in the market. He does like to see lower interest rates. So the crisis style of management that perhaps he and Elon Musk really got going in February and March, I think he perhaps got the word that doesn't play so well in markets. It's not well received. So perhaps they back off on that. ASX and property markets have experienced sharp swings with consumer and business confidence dipping in response to global uncertainty and trade disruptions, but not nearly as much as the S&P 500, which in turn was not nearly as much as the NASDAQ. Monetary policy will cushion the blow. The RBA is expected to cut rates multiple times, with the official cash rate potentially falling to 2.6%. We'll see if that happens. I'm leery. What I'm reporting here is the facts. This is what the market believes will happen. I'm not sure that we'll actually get down to 2.6% by year end. Lower rates will support borrowing and property prices. That's true, but do we want to support property prices given the valuations that we currently have? And that's going to partially offset negative sentiment and higher costs for some businesses. There'll be sector winners and losers, vulnerables, anyone exporting to China from the US, certainly, or from the US to China. But from Australia to China, maybe that's not so bad. We need to be clear here. There's really, two different export partners that we're thinking of with this particular presentation. Potential beneficiaries, retailers, and consumer goods companies may benefit from cheaper Chinese imports. What's interesting as we think about this is a company like Apple. Apple, an American company manufacturing in China, exporting to Australia. I haven't done a deep dive of that, but in theory, you would think that it would be unaffected by US tariffs because there's no part of the manufacture, or very little, I can't say 0%, but if all of the manufacturing and assembly is happening in China and then exporting straight from China to Australia, unchanged, possibly decreased if they're looking to make up volume that they would have otherwise sold in China. Investment strategies for uncertainty. There's the defensive positioning, focusing on domestic-oriented sectors with low volatility assets, strong balance sheets. Tactical flexibility, there are the points that I mentioned earlier, considering dollar cost averaging, maintaining higher cash reserves, and opportunistic allocation from particular trades. So watch for policy and trade shifts. Situation remains fluid. We keep our ear to the ground on a daily basis. It's my job to be able to explain what's happening out there to my clients, and I enjoy taking these opportunities also to explain what we're seeing out there to the public. So stay alert for Reserve Bank policy moves, US-China negotiations, and global trade realignments. New trade treaties that may be announced, very likely to be bilateral rather than area-specific. And of course, pay attention to Australia's ability to negotiate new trade deals and attract investment in emerging sectors will be crucial for long-term resilience. Okay, so that really concludes what I have for you today. If you're interested in learning more, please come to our website. If you're interested in finding a time to speak with me, you click on the Get Started, complete a very brief questionnaire, and find a time to talk. Next month, we're going back to regularly scheduled programming. Today's presentation had intended to be what we're seeing here, navigating the next chapter, estate tax mitigation, wealth preservation strategies for exiting Australian or US entrepreneurs and business owners. So that will be on May 20th in the US, and I thought I'd just open it up to questions at this point. Questions, concerns, or doubtful points that anyone here may have. Okay. Just giving folks a minute to type them out if you did have any questions. I'm going to guess that's a no. It's nearly lunchtime here in Brisbane. I'm looking forward to my upcoming trip back to the US. I'll be back in mid-June and returning to Australia it's the 9th of July. It's a question here. Monica says, thank you. That's very, very kind of you, Monica. Thank you as well. And Jeff Melton writes in, PR China, road China conflict, implications for Australia and oh, interesting. Okay, if I think I understand the question is the People's Republic of China versus the rest of China, otherwise known as Taiwan, I believe. Implications for Australia and the Australian dollar. Wow, what a great question. What would happen there? Jeff, I kind of feel like punting on this one because it's one we could do an entire webinar on, and how that would play out. I think Australia would be severely impacted because on the one hand, Australia is more economically aligned with China, but more defensively aligned with the US. And I think a conflict like that would really put Australia in a tough spot and force it to have to figure out who it's or where is its primary allegiance? Is it on the trade or is it on defense? And certainly the tariff war has brought that into sharp relief already, right? So Australia's been talking for the last few years about this AUKUS arrangement, spending hundreds of billions of dollars on nuclear submarines going into the next couple decades. So deepening alliances with the US. And at the same time, the US is hitting us with tariffs and it does not seem to be as predictable a partner as what it has been in more recent years. That's all I can really say about that. That's just such a big question with so many what ifs involved. Okay, nothing else has come in. So thank you, Martin. Thank you, Jen. Thank you, Monica. Thank you, Nancy. I appreciate your attendance here today, and you have a wonderful rest of your day. Thank you. Bye-bye.